Hi, we're at World Oil and Gas Week, joined by Crist. He is the Global Head of Natural Resources for IFC. Mr. Crist leads IFC's financing and advisory service teams who are responsible for supporting the oil, gas and mining sectors. So Lance, thank you so much for joining us today.
Thanks, Stevie. Good to be here.
I want to ask you, we've seen a lot in the energy sector. There's a huge transition towards cleaner energy, alternative energy, but a lot of these companies are kind of taking baby steps and doing, continued adaptation. So do you see 2018 as a time for real growth and development in taking bigger steps towards renewable and alternative energy?
I think I would look to 2018 as a firming up of the foundations rather than big steps per se, in the sense that what we saw after the crisis was a pretty significant deleveraging of the industry where debt was paid back, cash flows are being rebuilt, with oil price being stabilized. I think people are starting to see their way to growth in the future. At the same time, I think we're still focused more on M&A than we are today on projects really coming to the market ready for sanction. I think the market's watching a number of interesting projects around the world, especially in emerging markets where we focus. But I think many of those are still a year or two away from really getting to the point where they're going to reach FID, they're going to be sanctioned. But nevertheless, I think we are starting to see some progress in that direction because of the stability and because of the deleveraging that's happened.
We've seen a lot of talk from obviously big companies like some of the sponsors that we have here at the event and independents. We were talking a little bit earlier about how obviously those big changes often come from the top, from the bigger organizations. Right. Tell me how you think that trickle-down effect happens and when players perhaps in the independent field are really going to get involved.
Well, if I think of maybe the analogy of the IOCs being giant tankers and the junior oil and gas companies being smaller speedboats of sorts, the IOCs have very large portfolios, historically, in many cases oil, but they've done a tremendous amount recently to certainly publicly market the fact that they're doing much more in gas and renewables. And I think that's probably a bit more aspirational than it is a reflection of what their portfolios and where their cash flows are today. But I think it's important in terms of signaling to the market, to investors, and to the world at large where they see themselves going, where they see the energy markets going. On the other hand, the smaller companies, the sort of speedboats and mid-sized ones, they're really able to act more nimbly, but they're also more focused on maybe taking advantage of the higher oil price, looking at getting more modest-sized projects up off the ground, looking more at a midterm basis where we're still going to see very much a significant demand for hydrocarbons, be it oil or gas.
And, I guess it's a situation where perhaps an asset that, wouldn't be even a viable option for a bigger company is potentially really interesting and attractive for a smaller company. As you say, they're more nimble, but perhaps a little bit more, confined by their infrastructure.
That's right. The good news is smaller companies can bring a much lower cost basis, lower G&A. They can act more quickly. So projects which, frankly, aren't strategic on the radar for majors anymore that are being orphaned, being spun off. These could be good strategic cores for some of the junior companies. At the same time, these companies are more beholden to the existing infrastructure that's out there. They need a certain critical mass in order to be able to support additional infrastructure investment and whatnot. So where it's oil, you can tend to bring in FPSOs, you can rely on third parties to get your product to market. Where it's gas, it tends to be much more time intensive, capital intensive, and so longer gestation process.
Okay, so we've spoken about what's generally happening. I want to know, in your opinion, do you think companies are doing enough and making those steps that are increasing in size and getting bigger and bigger to be fit for the future?
I think largely yes. Look, the reality is, as IFC, we've invested about $8 billion over the last 5 years in energy. and 70% of that has been in renewables. So when we look at our overall approach to energy, it very much is with a view to trying to promote that type of energy which is really fit for the future. Low carbon, no carbon, and the like. Having said that, there still is a need today for the traditional fuels, and countries are looking to monetize their domestic assets and achieve the same kind of energy security that OECD countries want to have. So you still see a need in the more small, near to medium term for the traditional kinds of energies, and that's, I think, where the more medium term companies are starting to play. And at the end of the day, the skill sets and the competencies for a company, on the one hand, to develop a solar or wind project versus to develop some offshore field, they're very different competencies, very different capital requirements.
Yeah.
So to expect that a junior oil and gas company today is going to turn around tomorrow and become a solar company doesn't really make a whole lot of sense. And in fact, it'll be interesting to see how some of the IOCs who are really trying to develop these businesses are going to incorporate these into very different cultures. At the same time, I think we do see the market moving in this direction, and so we see progress.
So, speaking of the market, what trends are you seeing in terms of investments at present?
So on the renewable front, I think we're seeing some significant improvement where historically a lot of these one-off type projects, which took enormous amounts of time for governments to get through a tender process, bring in an investor, and do something on a bespoke basis. Now we're seeing much more standardization and scaling up, and so that's really helped in places like Argentina and Africa and the Feed and Tariff program in Egypt, where I think we're seeing a scale emerge and a standardization that will lower transaction costs and help penetration. At the same time, as I say, there will be challenges in companies retooling to address this kind of market.
And it would be great if you could tell us a little bit about the balance in your investment portfolio between oil and gas and renewables and alternative energy.
I would say 7-8 years ago, probably 2/3 of our portfolio was in upstream E&P, and about 2/3 was also in oil versus gas. And we've really turned that on its head, where again, the portfolio changes more slowly over time as repayments happen, as we exit. We're probably about 50-50 oil and gas today in terms of the portfolio, but most of our new business is in the gas side. That's somewhat through upstream, but it's also on the midstream side, where we're really working quite heavily on helping countries access the emerging global gas market by putting in place regasification terminals so that they can import LNG and help balance the energy needs within their countries. And I think as that takes more shape, we'll probably play a lot bigger role on the gas side, frankly.
And in your opinion, can you tell us, what is the appetite for risk at the moment when talking about different areas and different phases of development for oil and gas assets?
You know, I think we have experimented in the past with exploration. Some of those were very successful, others less so. The reality is, with our development mandate and our focus on helping countries really scale up their infrastructure, we're shifting much more closely towards trying to focus on development stage, producing stage assets for the upstream. We're also moving away from oil, frankly, because, again, keeping in conformity with what we see as the global trends generally, but also the reality is there's a fair bit of capital available for countries looking to develop their oil, whereas in gas we see much more risk involved on the regulatory front, market development, infrastructure development. So we see a bigger role to play on that front, and then again in helping develop downstream markets. So that's where we're going to be focusing more.
Okay. And so we've spoken a lot about the transition within the energy industry, and we only need to look around us to see how much technology is changing our everyday lifestyle. How do you think digitization will transform the oil and gas industry?
I think one of the things that immediately comes to mind is the role that electric vehicles and autonomous cars will play in transforming the demand for oil. I think when I look to the telecom revolution, there was a fairly slow increase in penetration and then suddenly an avalanche. And so I think it's certainly possible that we're going to see a much quicker adoption than is being forecast. At the end of the day, however, there's an enormous inventory of existing fleets that run on traditional fuels, which will still need to run. I think there'll be a slower penetration into things like freight and rail and these other areas. So there will still be a longer term need for the traditional hydrocarbons, oil, but as digitization changes the landscape, particularly for the vehicle fleet, I think that will transform things. Likewise, I think we're seeing digitization really have an impact on grid management, which is also facilitating greater renewables. And I think the introduction again, or the scaling up of renewables, is also changing the demand. So longer term, it will clearly impact the demand for the hydrocarbons, which I think fits with where the world needs to go in terms of managing its carbon intensity.
But you know, it's interesting. I mean, there are so many already changes going on within fleet management, you know, across industries. And so as soon as, you know, the big dogs are investing in that technology, then it becomes more and more accessible as it filters down. And, you know, now you can get a cell phone for £50.
Absolutely, absolutely.
Soon it'll be the same for an LNG gas truck.
Possibly, absolutely, absolutely.
Okay, so I want to chat to you a little bit about the event that we're at today, the World Oil and Gas Week. You have been attending these events for a number of years.
About 10.
About 10, exactly. So tell me a little bit about why you keep coming back.
My portfolio today is in, I would say, about 50 countries. And in addition to the clients that I have spread all over the world, we work with partner commercial banks, private equity funds, law firms, export credit agencies, sovereign wealth funds, to try and keep up with all of the partners, the clients, the sponsors is an incredibly difficult task given the focus that we have. And I find events like the Oil Council's events an incredibly useful way of really keeping those connections fresh. Obviously we use email, we use conference calls, we use video conference, and that's all useful. But there's very little replacement for the face-to-face. And having events like this where we can see a continent's worth of contacts over the course of a day or two, it's really difficult to put a price on.
And what would you say to somebody who is considering coming to an event or becoming a sponsor at an event and who's kind of on the fence about it?
As I say, I think it's incredibly valuable in terms of the exposure you get to people really from across all aspects of the industry, the financiers, the industry players, the service providers, in terms of getting your name, your brand out there, becoming known within the industry, and frankly helping to move and ultimately even create deals. So there's definitely value to it.
Well, thank you so much for joining us, and we really appreciate you chatting to us today.
Terrific, thank you.
Thank you.
Take care.